If I had to look at Palantir today from scratch, knowing what I know about the AI spending race, the government software cycle, and what happens when a great company gets priced like it already won the future, I would not start with the headline number. Most people see a report like this and go, revenue exploded, earnings beat, guidance went higher, therefore the stock is obvious. But that is not investing. That is reacting. And in a market where anything with an AI label can suddenly trade like it owns the next 10 years, reacting can get very expensive very fast. Palantir just put up the kind of quarter that makes bulls feel vindicated. The company is growing fast. The US business is on fire. Cash generation is no longer some distant promise. And management is basically saying, yeah, the demand is still accelerating. Today is Tuesday, May 5th in New York. Comment what day and date you are watching from, because the market you see today might not be the market someone else sees tomorrow. And if you value original market breakdowns like this, support by subscribing and comment John A.G. Best, so I know you are with the real viewers and not just floating through the noise. So we're going to walk through what actually happened, why the quarter was so strong, why the valuation is still the danger zone, why Amazon just spooked UPS and FedEx, and why Berkshire sitting on a mountain of cash matters more than the hype crowd wants to admit. And by the end, you should know the real question. It is not, is Palantir impressive? The real question is, how much perfection are investors already paying for? So let's get started. Now first, this was not a weak report. This was not one of those earnings releases where the company beats a lowered bar and then spends the call explaining away every problem with vague language. No. Based on the latest public filing, revenue came in around $1.6 billion, up in the mid-80s% range from last year, while adjusted earnings landed at roughly a third of a dollar per share. That is a serious beat, and the U.S. business was even stronger. U.S. revenue more than doubled. U.S. commercial revenue grew even faster, and U.S. government revenue also posted huge growth. That matters because Palantir is not selling a cute AI toy. It is selling infrastructure. It is selling software that large organizations can plug into messy operations, defense systems, hospitals, factories, supply chains, fraud teams, and government agencies. This is not, hey, we added a chatbot to the help page. This is, we want AI inside the actual decision system. That is why the story works. And to be fair to the bulls, the story is getting better. The company closed a little over 200 large deals, including dozens of bigger multi-million-dollar contracts. It also reported close to $1 billion of adjusted free cash flow, with margins that would make most software companies jealous. And management raised the full-year outlook toward the high $7 billion area, while also lifting expectations for U.S. commercial revenue and adjusted free cash flow. So if you are only asking, did the company execute? Yes, it executed. But investing is not just execution. Investing is execution versus price. That is the part people skip when the stock chart is going up and everybody online is acting like valuation is something only boring people talk about. No, valuation is not boring. Valuation is gravity. And gravity is quiet until it is not. Palantir has recently carried a market value in the high $300 billion zone, with the stock around the mid-100s and a price-to-earnings ratio that looks more like a science fiction prop than a normal public company multiple. That does not automatically mean it crashes tomorrow, but it does mean the market is already assuming a very big future. This is where the conversation gets uncomfortable. A company can be excellent and still be too expensive. A CEO can sound visionary and still not make the stock cheap. A platform can be mission-critical and still produce poor returns if the buyer pays too much. Think about it this way. If you buy a wonderful house for twice what the neighborhood can support, the house does not have to fall apart for you to make a bad deal. You can love the kitchen, the street, the backyard, the view, all of it. Your problem is the number on the contract. That is Palantir right now. The product might be real. The demand might be real. The stock might still be priced like reality has no speed limit. Now, I understand the bullish argument. AI spending is not slowing down. Government agencies want systems that can process information faster. Companies want to reduce labor friction. Defense budgets are moving toward software, drones, autonomy, and data fusion. And Palantir sits right in that lane. Also, unlike many AI names, Palantir is already profitable. It has real customers, it has cash, it has strong margins, it has a government foundation and a commercial growth engine. So this is not a bubble stock with no business underneath it. That is exactly why this is tricky. The bear case is not that Palantir is fake. The bear case is that the stock is asking investors to pay for a decade of outstanding execution today, and that is a very different risk. According to the latest market data, the stock was trading around the mid-100s with a market cap around the high $300 billion area. If a company is already that large, you cannot just say, well, it can grow. Of course it can grow. The question is whether it can grow enough, long enough, at high enough margins, without serious dilution, without contract delays, without competition, and without the market ever deciding the multiple should come back to earth. That is a lot of things to ask. And here's the part nobody wants to say during a euphoric quarter. Sometimes the best companies make the worst trades, not because the business disappoints, but because expectations become so tall that even excellent results look ordinary after a while. We saw this in earlier software cycles. Cloud names ran too far, some kept growing, some became dominant, and yet shareholders still had years of pain because the multiple was the problem, not the mission. Now let's talk about Alex Karp because he is part of the Palantir premium. Some CEOs are furniture. They sit there, read the script, say demand is robust, and disappear. Karp is not that. He talks like he believes Palantir is part company, part national security layer, part philosophical project. Some investors love that. I get it. In a market full of polished nothing, conviction stands out. But there is a thin line between conviction and distraction. When a leader spends too much energy firing back at critics, short sellers, skeptics, and everyone who does not clap loudly enough, investors should at least notice. The best revenge against short sellers is not a speech. It is revenue. It is renewal rates. It is cash flow. It is customers expanding. And Palantir has that right now. So the counterpoint is fair. Maybe Karp is intense because the company really is operating in a category where intensity matters. Maybe ordinary language would undersell what they are building. Maybe the market is right to pay more for a business that could become a core AI operating layer for governments and enterprises. But possible is not the same as guaranteed. And guaranteed is what the valuation is starting to feel like. Now add insider activity. I never want to make insider selling sound more dramatic than it is. Executives sell for taxes, estate planning, diversification, and because a lot of their compensation is already tied to the stock. Selling alone does not prove anything. But no meaningful buying at these prices is still a signal worth thinking about. If insiders are not rushing to buy while public investors are being told the future is enormous, maybe the future is enormous and the price is also enormous. Both things can be true. Now, while Palantir was dominating the AI conversation, another story hit the market. Amazon opened more of its logistics network to outside businesses, giving companies access to storage, shipping, distribution, forecasting, and fulfillment across multiple channels. UPS and FedEx stocks dropped more than 9% as investors immediately realized what that might mean. This is classic Amazon. Build the machine for yourself, then sell the machine to everyone else. It did this in cloud, it did this in advertising, it did this in marketplace fulfillment. And now logistics is getting the same treatment. But let me be careful here. Shipping is not cloud software. Trucks need drivers, planes need fuel, warehouses need labor, packages get lost, margins are not magic. So the idea that Amazon instantly turns delivery into another AWS is too simple. Still, Amazon does not need to destroy UPS or FedEx tomorrow. It only needs to take the attractive lanes, pressure pricing, win business customers, and make the market question the long-term economics of legacy parcel companies. That is enough to hit the stocks. And there is a deeper lesson for Palantir. When a company builds infrastructure for itself and then sells access to that infrastructure, the market can suddenly reprice an entire industry. That is the bull dream with Palantir too. If its software becomes the layer other organizations cannot operate without, then yes, the business can compound for a long time. But if everyone already prices it like that, outcome is certain, the upside gets thinner. That is the tension. And there is one more thing people miss with companies like this. The first phase of AI adoption is excitement. Executives approve pilots because nobody wants to be the person who ignored the next platform shift. The second phase is proof. Budgets move from experiments to production only if the tool saves time, protects revenue, reduces risk, or creates a workflow the customer cannot easily replace. Palantir is trying to cross that bridge right now. Its bootcamp model, its fast deployment style, and its land and expand motion are designed to make customers feel value quickly. That can be powerful, but it also means investors should watch the quality of revenue, not just the speed of revenue. Are customers expanding because the software is essential, or because AI budgets are temporarily loose? Are contracts getting longer or just bigger because everyone is rushing? Are margins holding because the platform scales, or because the spending cycle is at peak enthusiasm? Those questions matter more than a one-day stock reaction. And this is also why I do not like the lazy argument that bears just do not understand AI. Some bears absolutely do not understand it, sure. Some are just mad they missed the stock. But some are asking a real question. What happens when growth cools from absurd to merely excellent? What happens when a mid-80s% growth rate becomes a strong but normal software growth rate? What happens if the market stops rewarding every AI dollar equally and starts separating durable cash flow from excitement? That is when stock selection gets harder. Because in the early mania, everything with the right label moves. Later, the market starts asking who has pricing power, who has renewal strength, who has distribution, who has margins, and who can keep growing without handing away too much stock to employees. That is the phase Palantir is entering. And honestly, it might pass that test. I am not dismissing that. The company has done a lot of things skeptics said it could not do. It moved from a government-heavy story to a much stronger commercial story. It improved profitability. It turned AI demand into actual contracts. That deserves respect. But respect is not a buy button. Respect is the beginning of analysis, not the end of it. And that is the game. Now let's bring in Berkshire, because Berkshire is almost the opposite emotional temperature from the AI trade. While investors chase every company with accelerating AI language, Berkshire has been sitting on an enormous cash and treasury bill position, hundreds of billions of dollars, with official filings showing the insurance and other businesses holding roughly $370 billion net of unsettled purchases at quarter end. Operating earnings also rose, but the big message is still caution. They are not forcing money into a market just because money exists. That matters. Not because Berkshire is always right on timing, nobody is, but because discipline is a position. Cash can be a position. Waiting can be a position. Saying, I like the company but not the price, is a position. And that is where I land on Palantir. The company goes in the impressive bucket. The growth is real. The US acceleration is real. The cash flow is real. The guidance raise is real. The AI demand backdrop is real. The government and enterprise use cases are real. But the stock goes in the be careful bucket. Because at this valuation, you are not just buying a good quarter. You are buying a story that has to stay nearly flawless. Revenue has to keep surging. Margins have to stay elite. Customers have to expand. Dilution has to remain controlled. Competition has to stay manageable. Government budgets have to cooperate. And the market has to keep loving the multiple. That is not impossible. It is just a lot. So if you own it, know why. If you are buying it, know what price makes sense. If you are chasing it because the report looked amazing, slow down. Amazing reports update the math. They do not cancel the math. If you are successful, share your success story in the comments so others can stay motivated. Because the goal is not to win a debate about Palantir. The goal is to build a process that survives hype, fear, and your own impulses. The next few quarters matter. Watch whether commercial customers keep expanding after the AI excitement becomes normal. Watch whether government momentum stays strong. Watch whether free cash flow holds up after adjustments. Watch stock-based compensation. Watch insider behavior. Watch whether guidance keeps moving higher or finally starts to normalize. Most importantly, watch yourself. Because the most dangerous phrase in investing is, this time valuation does not matter. It always matters. Sometimes it just waits. This is for educational purposes only, not financial advice. I am sharing how I think through the business, the valuation, and the risk, but you need to do your own research, understand your own situation, and make decisions that fit your own financial life.